Hey everyone, welcome back to the channel. Today, we're diving into a topic that's crucial for anyone involved in Forex trading or international finance. We're going to explore how tariffs on Canada can affect the foreign exchange market. So, whether you're a seasoned trader or someone just interested in the global economy, this video is for you. Let's break it down. 1. What are tariffs and how do they work? First, let's quickly cover what tariffs are and how they work. Tariffs are essentially taxes or duties placed on imported goods and services. They make foreign products more expensive for consumers in the importing country. These tariffs can come in many forms, from taxes on raw materials to finished products, and they impact everything from the price of goods to international trade relationships. For example, if the United States imposes a tariff on Canadian steel, the price of Canadian steel will rise for U.S. buyers. The idea is that this encourages consumers to buy locally produced goods instead, but it also makes trade more expensive. 2. How tariffs impact the Canadian economy. So how do tariffs specifically impact Canada's economy? Well, Canada is highly integrated with the global market, particularly with its largest trading partner, the U.S. A significant portion of Canada's GDP comes from exports. The U.S. buys everything from oil and gas to timber, cars, and agricultural products. So, when tariffs are imposed on Canadian goods, the immediate effect is a reduction in export demand. Now, when demand for Canadian goods decreases, Canadian businesses might face lower sales, lower profits, and potential job losses. This creates a ripple effect across various industries and ultimately affects the country's overall economic performance. 3. Impact on the Canadian dollar. So, how does all of this impact the Canadian dollar, or CAD, on the Forex market? Well, when trade between Canada and its partners is restricted due to tariffs, demand for the Canadian dollar tends to decrease. Because less demand for Canadian exports means that fewer foreign buyers need CAD to complete their transactions. As a result, the CAD may weaken against other major currencies like the US dollar, USD, Euro, or the Japanese yen, JPY. This is known as currency depreciation. Investors and traders who were previously holding CAD may begin to sell off their positions, leading to a further decline in the value of the Canadian dollar. Think of it like this. When trade slows down, the money that would have been flowing into Canada is reduced, and this causes a weaker currency. 4. How tariffs affect investor sentiment. Another crucial factor in how tariffs affect the Forex market is investor sentiment. When tariffs are imposed, especially if there's uncertainty about the future of trade relations, investors may become more cautious about Canada's economic stability. In uncertain times, investors tend to pull their money out of riskier markets and move it into assets perceived as safer, like the US dollar or even gold. With less confidence in Canada's economic future, we might see a shift of investments from Canadian assets into more stable currencies. This would likely cause the US dollar, often seen as a safe haven, to appreciate against the Canadian dollar. That means, as an investor or Forex trader, when you see tariffs being imposed, you might expect increased volatility in the CAD, which could make it an attractive opportunity for traders looking to capitalize on currency movements. 5. The role of interest rates and inflation. Now, let's talk about interest rates and inflation. When tariffs cause inflation, which happens when goods become more expensive due to trade restrictions, the Bank of Canada may need to step in. If inflation rises, the Bank of Canada might raise interest rates to keep prices in check. Higher interest rates can attract foreign investment, potentially leading to a stronger CAD. However, if tariffs hurt the Canadian economy too much, the Bank of Canada might choose to lower interest rates to stimulate growth. Lower rates usually mean a weaker currency, so this could make the CAD even more vulnerable to depreciation. In short, the direction of the CAD depends largely on how the Bank of Canada responds to the economic pressures caused by tariffs. Interest rate changes are a crucial tool in balancing inflation and economic growth. 6. Broader market effects and volatility. Tariffs don't just affect the Canadian dollar, they can cause global market volatility. When countries engage in trade disputes, it creates uncertainty in the market. Traders often dislike uncertainty, and this could lead to large fluctuations in currency values. Let's say Canada imposes retaliatory tariffs on U.S. products. This could escalate the situation and lead to a trade war. In such a case, not only the CAD but also the USD and other currencies might experience significant volatility as the market tries to price in the potential for future disruptions. Traders in the Forex market will be watching these developments closely, looking for signs of escalation or resolution. The uncertainty surrounding the situation could drive sharp movements in both the CAD and other major currencies. So, in summary, tariffs on Canada can have a significant impact on the Forex market. They can weaken the Canadian dollar, cause inflation, affect investor sentiment, and lead to global market volatility. For Forex traders, this creates both risks and opportunities, depending on how you play the situation. If you found this video helpful, don't forget to hit that like button, subscribe to the channel, and leave your thoughts in the comments below. What do you think about the impact of tariffs on the Forex market? We'd love to hear your insights. Thanks for watching, and I'll see you in the next video.